I'm very confident that majority of retail traders are using volume completely wrong. Let me ask you, how many times have you ever entered a trade? You got a great volume confirmation, but despite the volume confirmation, the market reverses, it stops you out for a loss, and you get so frustrated because you saw all the volume coming into the market and you thought the market was going to move in your favor. It didn't, and now you're sitting there in frustration with the loss. In this episode number 6 of the OrderFlow series, I want to go over how to use volume the right way and how we have to focus on volume by price and how much more efficient it is than volume by time. In episode number 5 of the OrderFlow series, I go over support and resistance and why it forms and how to use it correctly. And this video is just gonna supplement this. That way we can use volume around support and resistance or volume around our key levels in the most effective way. That way we could take higher quality setups. Now, if you're new to the OrderFlow series, I would recommend subscribing to my channel and also following me on my socials in the link in the description below. That way you stay up to date on all future episodes of this OrderFlow series. But now let's dive deep into volume and how to use it the right way. So let me ask you all first, how many times have you tried to buy a breakout on high volume? You've learned before that as soon as the market's breaking out above the resistance level and the volume is increasing, you are going to take the market long above that resistance level. You're seeing it break out above a high. The volume is increasing, and automatically, because of that fact of the volume by time increasing above the resistance, you take it long. Now, as soon as you take it long, the market eventually reverses on you and you got to stop out for a loss. And this was a fake breakout and the market eventually dumps and you took a very big loss because you were completely wrong on how you read it. If you buy every single breakout with not putting an emphasis on volume the right way, then you are simply positioning yourself to become trapped by smart money who are more patient traders. We talk about this a lot in episode number 4 of the series, and we're basically giving them your liquidity. When you're buying this breakout, they are selling, right? So for every transaction, when there's a buyer and a seller, if you're buying this and there's a lot of buying volume coming in and the market dumps, well, then you have to view this as someone who is patient or smart money is selling into you because you're buying and providing liquidity for them to sell. For me, I am always looking for reversals first on breakouts. I am never, 99% of the time, let's not call it never, so 99% of the time, not playing breakouts the first test. I am first looking for reversals on the first test of the breakout. And because of this, we have to go over the high volume reversal setups. This is my go-to, and this is going to make sense because in my opinion, a lot of traders are using volume the wrong way. They are putting too much of an emphasis on volume by time and not much of an emphasis by volume by price. In this OrderFlow series and all the examples that I've given so far in all of the episodes, we've talked about volume by price and not so much of volume by time, because volume by time doesn't show a true picture of what's going on behind the scenes. In this example of the high volume reversal setups, again, always looking for reversals first on breakouts because I don't want to be giving my liquidity away for other traders who are patient or smart. I want to be the guy who's smart and patient that I can use other traders who are struggling or other retail traders who are impatient. I can use their volume, or I could use their order flow to my advantage. And when they are buying, I could be selling, especially above a resistance level. In the previous episode of this order flow series, number 5, we talk about how support and resistance has to be used correctly. And a lot of people draw it the wrong way. But in this example, drawing it the wrong way would be just marking this high or this level where the market had rejected 2 times, and people would call this resistance. Now, what a lot of traders would do is they would extend this. They would see 2 days later, the market's breaking this resistance level. We have a really strong opening rally candle. This thing's looking really good. This thing's breaking out above the resistance level. Hey, we just broke out. Let me take it long. The volume's spiking. That means we're going to break out, and this should have continuation. How many times, be honest, let me know in the comments, do you use volume by time and say, hey, the volume just spiked And just because it spiked, I'm going to get long because it's breaking above the resistance level. This is the complete wrong approach. Playing continuations above resistance or playing breakdown continuation below support. Using a volume spike, volume by time, is not an efficient way to gauge if this resistance level actually will have continuation and will actually break out to the upside. It is not efficient at all. Here we see the same thing. The market rallies up. And keep in mind, in real time, you don't know what happens next. In real time, all you see is a really strong green candle up into this resistance level. And if you were to go by volume by time, you would see a really large green aggressive volume bar here with a strong volume spike saying, hey, we have a strong green candle. We have a lot of buying volume. This thing should break this resistance level. And at some point, I'm sure a lot of traders are buying this breakout, expecting it to break out, which this, for me, is a high volume reversal setup where, again, I'm looking to play reversals when I see these signs. Now, let's dive a little deeper and understand what causes the volume to spike and why do we have a volume spike and why do we have a strong green candle but the market dumps after it. This is why volume by price is superior to volume by time. Volume by price, again, seen by a footprint chart, seen by a heat map, seen by a depth of market, will give us the true clear picture of what's going on behind the scenes. Why there is a strong volume spike here by time, this is a 30-minute chart, so each candle is 30 minutes. Why we have a strong 30-minute volume spike here is if we were to go from 10 to 10:30, which is highlighted in these 5 bars right here, from 10 to 10:30, what we're going to see in this information is number one, of 1,700 total volume and a 1,300 positive delta. Over here, we're going to see a 620 total volume and a 620 positive delta. Over here, we're going to see a 1,200 total volume and a 577 positive delta. Same thing up here, 585 positive delta, and we're going to just see even stronger volume as the market's breaking out. So the fact here is that as the market is breaking out and what looks bullish is not bullish. You have to ask yourself, and I've talked about this in another episode of this series, putting yourself in the shoes of other participants or other traders. If there's a lot of volume here breaking out, specifically a lot of buying volume, you have to ask yourself, why is the market not breaking out, or why is the market not continuing? The market will move up until the last buyer buys. In these examples, we see a lot of buying volume coming into the market, and despite all this buying volume, the market does not move up. This is an indication that the buyers are becoming exhausted. Buyers are going to buy until the last buyer buys, and then the market has to sell off. There's more passive selling here because the market's not going anywhere despite all this aggressive buying. And Carmine, how do you know there's aggressive buying here? Well, there's all this positive delta which hit the offer. So that has to be aggressive buying. And if we're seeing all this positive delta not bring the market up, this means there's a passive seller here. If there's more passive sellers at the level of resistance than there is aggressive buyers, then the market has to reject and will dump and formulate a valid resistance level where we could use at some point later in the future or right now to take a reversal setup. This is why I'm mainly looking for reversals confirmed with the order flow. When everybody's buying the breakout, you're positioning yourself to become trapped. Who is selling to them if we see all this buying volume here? We can use this to our advantage to capitalize on a downside bearish move or look to play puts in the market. I talked about this example in the previous episode of this series. This right here looks bullish, right? We're consolidating right near the high. The market, the previous times testing this, had sold off immediately and sold off aggressively. Now we're consolidating right at or near the high. You cannot lie and say this does not look bullish. For me, it does. Consolidation near the high is bullish to me, that more upside prices are likely. Well, guess what? The market breaks this resistance level and immediately dumps after it breaks. Would you want to get long on that breakout? Wouldn't you want to get short? Now, a lot of people are going to say, hey, the volume spiked here. It's the opening candle right above the resistance level. Again, this is the high volume reversal setup that I'm looking for, and we can confirm this with the order flow. When there's a lot of buying volume, and I'm going to be very repetitive with this in this episode, when there's a lot of buying volume or a lot of buying effort, and there's a lot of aggressive buyers stepping into the market, but they cannot bring the market up higher, especially at a level of resistance, this is a reversal pattern for me, and this is when I look to be a seller present in the market because I know the passive sellers are stronger or more serving like a wall that the aggressive buyers cannot overtake this wall. And this is why the resistance level forms. So on a candlestick chart, using volume by time, which again is the wrong approach in my opinion, all these examples are going to validate that. This is the wrong approach because you are using this volume spike, which technically the volume is elevated. But using it by volume by time, you're not going to be able to differentiate if this is buying volume, if this is selling volume, if this is passive, aggressive volume. Like, you're not going to be able to differentiate what type of volume is here. You're just going to say, hey, there's strong volume. And in this example, yes, there's strong volume, but this is not strong volume for more upside prices. This is more strong volume for a reversal and to capitalize on a downside move. So being able to differentiate this with the order flow and with volume by price will always be superior than volume by time. And again, we could see this example. We could see it break the resistance level. We could validate everything that I'm saying. So like everything that I'm saying could be validated with the order flow. The market breaks out, the buying's strong. Tries it again, the buying's even stronger. The market moves up until the last buyer buys. What you're going to see at every high or low is aggressive buying, but no upside follow through, or strong trades hitting the ask with no upside follow through after that. And in here, we see the same exact thing. Aggressive buyers above the resistance. All this volume here is what's shown by the volume spike down here. But being able to say, hey, there's a lot of buying here and no follow through, this is a weak indicator that the market should not move up, that it in fact should move down, and I could look to play this high volume reversal setup. And I could repeat this forever and ever. Like, here is a few days later, the market revisits this resistance level. We come into it. We see the volume spike, right? People are like, hey, this thing's going to break out. We're trending up. The volume's strong. This thing is going to keep moving up. And you see the volume spike. You get long just because the volume's there, but you're getting long. You are the cause. I'm not going to say, let's not call it you, but majority of the other traders, if they all come together and are buying this breakout, is the cause of the market dumping, because if everybody's doing it, the effectability of it working becomes much slimmer. We could see the buying, and we can validate this all here. Buying here, buying here, buying here as the resistance breaks out. Despite this buying, the market's not going anywhere. In fact, the selling steps in thereafter, and there's a lot more red after this high forms. This is a high volume reversal setup, and volume by time is not as efficient as volume by price. And we could see this with the heat map. We could see strong bubbles at the high, at the high, at the high, and then the aggressive selling steps in and then the market dumps. Same visual that we could see on the footprint, we could see on the heat map. And then here's the dump. I could go on this forever. This is a classic. Why I always look to short or play reversals at resistance, or look to long a break of a support level or a low first, rather than going for continuation. Another example here, we could just mark a normal high of day. A lot of traders just mark simple high a day, low a day, pre-market high, pre-market low. Yes, this might work out for you 10, 20% of the time, and you might have some trades that this does work and it is efficient. But in this example, the market had broken above the high of day, and we could see the volume has increased here. In fact, this whole volume bar is more green. Volume by time is not as effective as volume by price. This, off this chart and off this volume, if you were to go with the conventional way that a lot of retail traders learn about trading and playing breakouts, this is a very good long setup right here. But if you understand, you watch my videos and you take this to heart and you study this and you back test this, this is a high volume reversal setup. We see the volume increase as the resistance level is breaking, right? If we dive deep into why this high volume forms, we're going to be able to see that the volume forms because of a strong buying volume. But despite all this strong buying volume, the market can't move up. So yes, we see the high volume on the charts, but why the high volume formed on the charts is because on the order flow, people are hitting the offer aggressively and the market can't move up because of this. This is the high volume reversal setup. We could even validate this with the volume by time on here, right? This is just validating all the concepts even better. And then the market dumps. And this is a trade that I look to first short or play a reversal because of the high volume setup. And we could see the same thing off the footprint. The high breaks, it leaves a volume tail, and then the aggressive selling, the red prints come in thereafter. This is a textbook A+, 10 out of 10 setup that I'm taking all day long because I know how effective it is. It's all about finding setups that are effective, that I have tested, that I know work out very, very well for me, especially ones with minimal risk. And this is it right here. Same thing, now flip it to the downside. We have a support level. Rejected the market here, bounced the market, bounced the market, bounce the market. Now, as soon as this level breaks, everybody's watching it. It's very obvious. I talk about obvious versus non-obvious in the previous episode of this series. So this is very obvious. Hey, as soon as it breaks, I'm getting short. Hey, the volume just spiked as this level broke. This is looking good. This thing is going to sell off. This thing's going to dump. It's going to tank. We're going to panic. This thing is going to sell off and I'm going to make so much money, right? We see the volume spike. We see it all here. We see the aggressive red candle. We see the support level breaking. Everything is aligning for more downside. But this is the wrong approach to the market. It breaks the support level. Volume is the highest here. Guess what? Directly after volume was the highest was literally the low of this sell-off. This is the high volume reversal setup that I am talking about. Do not do what majority of traders are doing, and majority of traders are doing this right here, shorting the lows and buying the highs. We can validate this with the order flow. As soon as this level breaks, look, the market moves down until the last seller sells. I talk about this in that previous episode. We can see all the aggressive selling at the low, yet the market is not moving lower. The market only has one option, and that is to move up. We can see this with the footprint. We can see as the market's selling off, the selling is getting exhausted. The selling is drying out, meaning the selling is getting weaker as we're moving lower. This is a sign that the market could reverse. Now the buying steps in. We can see the delta building and building and building and getting larger. And this is the high volume setup. We could look to capitalize on a reversal. Traders do not understand how dynamic the auction process of the market is. Retail and big money are the auction. Big money has a need to stay ahead of retail for their orders to be filled. Why this actually forms high volume right here is because smart money, big money, patient traders call them, are simply buying from everybody else who is selling, which is causing this volume spike. If smart money has to buy, they want retail traders to sell. This is why a lot of the times they're going to make selling look like buying or buying look like selling, because if they have to sell, they want everybody else to buy. They don't want competition. We are their bait. We have to outsmart the fishermen. We don't want to be shorting the support level. We want to be looking first to long it. And this is how I approach the market. Now, yes, there will be some times where it breaks the support level and dumps and continues selling off. There's no strategy that's going to work 100% of the time. But especially mean reversion markets, call it the S&P 500, this, call it more than 50% of the time occurs. And anything that's better than 50% is a great edge in the market. Now, because of this, there will be times that there's continuation and we can't always look to play reversals. I'll be wrong if the market breaks the level of support and then, comes back and then keeps selling off. So there will be continuation. The market cannot always reverse. If it always reverses, it would simply just ping pong back and forth. You'd have a market that looks like this, right? But that's not a healthy market at all. A healthy market is where you go like this, right? Where we consolidate, we move up, we sell off, right? A sideways market is not healthy. It's normal, but it's not healthy to always reverse up, down, and ping pong back and forth. Now, for continuation, let's talk about this. How many times have you tried buying a dip or catching a falling knife because you spot large volume, but you end up losing? Hey, the thing's dipping, but as soon as it dips, the volume is increasing down here. And because it increased, I'm going to get long and look to capitalize on an upside move. The volume increased. There's some strong volume here. Let me take the market long at the support level. For me, continuation occurs when there's large volume because a lot of traders get in on that large volume. We're talking about continuation here. We're not talking about reversals. Usually, rallies and pops after a strong drop is great to short into for more continuation. What I mean by that is if the market's downtrending, this is especially for downtrends, and then all of a sudden it pops up. We start moving up higher, right? And on this pop, the volume increased. This would be something that I'm looking to short into if I could read the order flow of what caused or what side of the volume made the volume increase. Or to the downside, if the market's rallying up, right? And then all of a sudden we get a quick move up and then a quick pull back down. And on this pull back down, the volume is significantly higher right here. This would be a move that I'm looking to long or play a bullish position in an uptrending market because I am looking to buy for more continuation on those quick sell-offs or those quick pullbacks on uptrending markets. So this right here is for uptrending markets and this right here is for downtrending markets. Let's visualize this. So here we can see the market had a strong uptrend, a strong move up, and we want to gauge if the buyers from this rally right here are strong or if they fail and they're not so strong. The trend line breaks right here. Many are shorting a trend line break. We talked about this in a previous episode. We can confirm this by the volume. The reason why the volume spiked here is because majority of traders are shorting that trend line break. And if majority of traders are shorting that, you have to ask yourself who's buying it. Smart money's buying this right here. So this would be a great opportunity to buy because of the volume spike. With the trend line breaks, the volume spikes, and then the market continues and rallies up higher thereafter. So it's all about spotting and using this to our advantage, especially when we could dive deep into the order flow, volume by price. This is just giving us context. We could see and validate that someone's buying this up because of the volume spike. No one's selling this smart money wise. Smart money is buying this move. And we can validate with this with the volume by price because as the market's pulling back here, we could see all the aggressive selling into the low. The trend line breaks, there's selling here, and if there's a lot of selling, who is buying it? And we can see this with the footprint, a lot of red on this pullback. Red means aggressive selling. If there's a lot of aggressive selling and the market's holding, this is a very bullish indication. If the market consolidates, despite all the aggressive selling, despite all the aggressive red, and it holds on the pullbacks, that means somebody is passively buying the market. If there's more passive buyers than there are aggressive sellers, that means the market has to move up in terms of an auction. That means the aggressive sellers dried out or the market pulled back until the last seller sold. We can validate this here, right? If you were to look at the footprint and really dive deep, the last volume print right here is 178 total volume and negative 178 delta. That means everybody at this specific price right here on this range sold. That there was last seller sold, that there was all sellers. The market will move down until that last seller sells. Here's another example. Would you take the trade long right here? You see it breaking out down through this downtrend line. You see the volume spike right here. This would be something, look, strong green candle. Be honest with me. Like, would you take this thing long right now? And I would say more than 50% of traders would. Again, switch the mindset. This right here looks very bullish. If you want to confirm it by volume by price, this looks very bullish breaking out right here. But again, on breakouts, I am first observing the auction for reversals rather than continuation. The buying volume is strong. There's a lot of green aggressive bubbles and aggressive buying as the market's breaking out. This typically is a bullish indication. But guess what? Despite all this aggressive buying, the market went nowhere. If there's a lot of aggressive buying, but no follow through, that means a seller is sitting there passively. And we can use that to our advantage to play a reversal. Very simple concept. And I keep repeating myself in this video because of how simple and effective it is. If there's a lot of aggressive buying volume, but no upside follow through, especially when there's a volume spike, this validates that someone is selling the move into those who are buying the move. Majority of retail would buy this. And if majority of retail are buying this, who is selling it? Those who are smart are selling this. And then some more continuation volume setups is how many times have you tried buying a dip, catching a falling knife because you spot large buying? Usually those rallies or pops after a strong drop are great to short into for more continuation. The market had dropped here, right? We had sold off. Here's that quick pop up on the volume spike. This volume spike, I am first looking to short into on the strong downtrending moves. If we're rallying up and we're uptrending and we see a quick strong sell-off or a quick pullback, this is great to buy into for more upside continuation. And we could see that in this example. The market had rallied up. We see the volume spike here. This is a great opportunity to buy the market and capitalize on an upside move. And one last example for this continuation setup is here we have a support level. The market technically breaks the support. Volume is a little elevated by time. Again, this is why volume by time is not as significant as volume by price. The market dumps. We could see right here a lot of aggressive red bubbles, a lot of volume down here, volume by time, if you want to call it. So we know sellers are stepping into the market. Well, despite all this aggressive selling, we could see the highest negative delta of the session so far. We could see a negative 462, a negative 514 delta here. Significant selling volume here, but the market could not sell lower. If everybody's selling, who is buying? Smart money's buying. And this is how we can look to capitalize on these moves. Now, a break of resistance and support for continuation. I really wanted to dive into continuation because support and resistance, a lot of traders are used to it, having continuation and playing breakouts. But like I've been mentioning, I rarely ever simply buy when the resistance breaks or when the support level fails. I rather let it break first and then buy the pullback or short the rally like I just mentioned. So it's a two-step process. Number one, let's say we have a resistance level right here and the market's going and breaks the resistance level. Point number one is this right here. Point number one is if it breaks, we can validate that buyers and sellers are strong. And this is if we're playing continuation. So point number one, we validated that it was strong. If point number one is validated and the rally or drop forms, so point number two now is if not point number one is validated and we get that rally or drop, we want to see buyers or sellers defend price. And what this means is if we can validate that buyers were strong at point number one on that breakout, ideally a pullback into the resistance level should now turn into support. This just shows that the buyers who were on point number one are even stronger because they are defending, keyword here, defending price. So point number one shows buyers are strong. Point number two defends it and validates it even more and just gives me more conviction or makes it even more powerful. It's the two-step process. So here we could see that same support level break that I mentioned earlier and in the last episode of the series where we have support, eventually it breaks. Now again, I don't short just because the support level breaks. Instead of shorting the obvious break, what I rather do is let it break first. Let everybody get short. Let the market stop them out. What I mean by let the market stop them out, put yourself in the position of other traders. If you are shorting the breakdown and you are short, the market goes against you, it pops. You are going to have to buy to cover to essentially exit that trade. For you to cover, that's going to have to get you to stop out, which is then going to cause a volume spike. This is why I like playing those volume spikes when the market's downtrending or uptrending, instead of playing that level once it breaks on the first test. So here's the classic spike up. The old support level now acts as resistance on two different occasions. And this is where I look to short the pops or short the rallies, especially now this is now acting as resistance, which it was once support. We can validate this with volume by price. Here's our double bottom of support. Here's our volume spike. Why this is significant to me is because the traders who shorted this breakdown, once the market goes against them, they have to stop out for a loss. For them to stop out, they have to buy. This is when we get the volume spike. This is when we can confirm it with the buy bubbles or the green bubbles. And this is a move that I look to capitalize on a reversal for continuation, essentially, where I'm looking to short the pop or short the rally, especially now that this old support level has now turned into resistance. And we can validate with this with the footprint, just showing you the same thing, just with different visuals, just so you can see the both tools. Again, this is episode number 2 and episode number 3 of the series, where I go over the heat map and then I go over the footprint. We could see all the aggressive buying, validating what I just said here. We could see it acting as resistance now that that support level has broken, just validating even further. And now let's talk about resistance acting as support. Point number 1, point number 2, we could see a clear resistance level. The following session, the market breaks it. I'm going to get into the break and how we could capitalize on this. But after it breaks it, let's just say we follow Carmine's advice and don't play the break, but instead we play the retest. Let's dive into deep here why or how this retest formed. This now didn't really have a volume spike, but had a little bit of elevated volume. But now this old resistance level has now acted as support. Strong selling. We can see the delta, the highest of the session so far. We can see a negative delta of minus 750, minus 583. The market sold off. There's a lot of selling here. If there's all this selling, why cannot the market move down? It's at a now new support level. We're seeing the selling at a level of support. The support's not breaking. This is a good reversal indication, or if you want to call it continuation. Yeah, we're playing a reversal because we're longing the pullback, but really the trend is technically still up. So we're playing continuation of the earlier move, which the earlier move was a rally up. So a lot of aggressive selling, but no downside follow through is a good indication the market will start to move up. If everybody's selling, you have to ask yourself who is buying. Smart money, patient traders are buying from majority of traders who are selling. The common theme and the common mantra of this video. And let's talk about point number 1 now when the resistance level breaks. Let's act like we don't know what happens over here, but we're seeing it in real time break the resistance level. Well, I just said earlier that I don't get long as soon as the level breaks. But what I will do, like I talked about in the previous episode, is I will look for signs of buyers before it breaks to get long. And I could get in before the resistance level breaks, and then I could use that resistance level break as a target. So instead of getting long, this is the same resistance level here. Instead of getting long when it breaks, as soon as it breaks, this is an example of it would have worked out if you got long as soon as it breaks. But how many times can you come back to me and say, hey, this works 90% of the time, that as soon as it breaks, it's going to have continuation? I wish it was the case, but it's not. So instead of getting long as soon as it breaks, in this example, it would have worked well. What I like doing is getting long before the resistance level breaks, speculating or saying it will act like a magnetic force where the market could gravitate towards. In this example, we could see the green line being a previous intraday high. The market had pulled back here on this red candle, and we could see the volume spiking as it's pulling back, validating what I just said before about looking for pullbacks on strong uptrending markets where the volume spikes. People see this red candle, and a lot of people will say, hey, the trend just broke right here, right? They mark this little green line. The trend just broke. I see a strong green candle, a strong red candle, strong engulfing, the volume spiking. Let me take it short. When majority of people are thinking this way, again, I am thinking of the opposite, and I am going against them. This volume spike occurred here because of the strong volume that appeared as the market aggressively sold off. This also aligns with the previous day high. This is a great opportunity to take the market long before the resistance level breaks. This opportunity to get long is right here when the volume spikes on the strong uptrending pullback versus getting long when the resistance level breaks. Again, this is an example of strong continuation. As soon as it breaks, it's not always like this. But wouldn't it make sense to get long here rather than here? Because now what this does is it maximizes your risk, right? My risk box is much higher. If I got long here, my risk box is here, or my reward box is here. So now my reward is much higher getting long here than it is here. And if my reward box is a lot larger, then that means my risk box is a lot smaller. If I got long up here, my risk box would have to be like down here. So now on example number 1, getting long at the first circle, my risk to reward is greater than it would be over here. And we want to position ourselves to get in when the risk to reward is higher. That way we could afford to be wrong as much as possible, yet still come out green. Now, in the next episode of this series, I'm going to talk about how I confirm my setups and how I get great risk to reward ratios and what actually makes me click the buy or sell button. Where do I put my targets? Where do I put my stop losses? And really how to manage the trade from start to finish. That's going to be episode number 7 of the series. If you're new to the channel, I would recommend subscribing. If you have any questions, I would say comment. I'll go through all the comments and answer any questions you may have. And if this is the first episode of the series, I recommend going back to episode 1 and watching them in order, because this is a very strong, powerful, and effective series about how I view the market, especially using order flow. So I'm going to end it on that note. Definitely check out the other videos, like this video, comment any questions, subscribe to the channel, and I'll catch you all on episode number 7. Peace out.